Zomato's food delivery business is finally making a profit. But what if I told you they're using all that money and more to fund another business that's still losing a lot of money? This isn't a story about failure. It's the story of Zomato's huge risky bet on Blinkit. For years, Zomato was a famous example of a startup that spent a lot of money to grow. Then, something changed. The company, now officially called Eternal Limited, turned a corner and announced it was finally making a profit. The stock market was happy and it seemed like the long, difficult journey was over. But if you look closer, there's a much more complicated story. Zomato has basically split into two parts: a stable, profitable food delivery business and a wild, unpredictable, and very expensive bet on the future of online shopping. The whole company is in a tricky situation. Can their profitable food business actually pay for this huge risk, or could the entire thing easily fall apart? For 15 years, the question was always, will Zomato ever make money? Then in 2024, it happened. The company reported a profit across its entire business, and it has managed to keep making a profit since then. So, how did they do it? It was a mix of small, smart changes you probably noticed. That little platform fee that was added to your bill, that was a big reason. Zomato also got much better at selling ads to restaurants and made its delivery service more efficient by spending less and finding better delivery routes. For people who invested in the company, it was a huge relief. Zomato had proven it could be a business that can last, not just one that spends money to get bigger. But just as everyone started to celebrate, Zomato made it clear that being stable isn't enough. They want to completely lead the market. And that's where the real puzzle begins. If you look past the headlines and at Zomato's financial numbers, you'll see it's not really one company anymore. It's two. Think of it like a responsible adult and a rebellious teenager living in the same house. The mature, predictable food delivery business is the adult who pays the bills. It's the part that brings in the money. Then you have the quick commerce business, Blinkit. That's the teenager with a $1 billion dream, spending lots of money to build something new from the ground up. Zomato's whole strategy is using the adult's money to fund the teenager's dreams. This has made their financial reports look very strange. In the second quarter of the 2026 financial year, the parent company Eternal's net profit dropped by 63% from the year before, down to just 65 crore rupees. Why? Even though total income nearly tripled, expenditures exploded, mostly because Blinkit was growing so fast. This is the core of the puzzle. One business is making money while the other is spending it just as quickly. First, let's talk about the part that powers everything, the food delivery business. After a decade of challenges, this part of the company is now a great example of how to be profitable. It controls a huge 57% of the food delivery market in India, a market that is still growing and expected to become a massive industry. In the last quarter, Zomato's food delivery didn't just grow, it became more profitable than ever. The total value of all customer orders grew by a steady 14% compared to last year. But the real story is in the profit margins. The business made an operating profit, that is adjusted EBITDA, of over 500 crore rupees, and its profit margin reached the record high of 5.3%. This didn't happen by accident. It's because of those platform fees, growing ad income from restaurants, and the fees on every order. This business is a very efficient system with a huge number of users and a clear way to keep making steady money. This is the money that Zomato is using to make its biggest bet ever.
Now for the risky part of Zomato's plan. Blinkit. Quick commerce, delivering groceries and other items in 10 to 20 minutes is a very tough and expensive business to be in. And Zomato is fully committed. Blinkit's growth can only be described as extremely fast. Its income in Q2 FY26 grew an amazing 8.5 times compared to the year before, reaching nearly 9,900 crore rupees. This was partly because of a change in how they count their money, but the real growth is still huge. It now has a leading market share of over 45% for quick grocery delivery in India. But this growth comes at a huge cost. While the food business makes money, Blinkit is still losing it. In Q2 of FY26, Blinkit lost 156 crore rupees in operating profit. Basically, Blinkit over 400 stores work much like Blinkit used to. This loss isn't a sign of failure. It's the cost of growing so quickly. Blinkit opened 272 new special warehouses, called dark stores, in just that one quarter, bringing its total to over 1,800. The company plans to have over 2,000 stores by the end of 2025. And they're going to reach this goal a whole year ahead of schedule. Building and stocking these stores costs a lot of money. And that's exactly where the food delivery profits are going. This risky plan, balancing a profitable present with an ambitious money-losing future, is one of the most interesting business stories right now. If you find this analysis helpful, do me a favor and hit that subscribe button. We break down complex plans like this every week, and your support helps us continue. So, is this a messy plan or a brilliant move? It's a big strategy. Zomato is deliberately giving up profits now to win a much bigger market in the future. The logic is simple. Use the steady cash from the food delivery business to pay for Blinkit to expand and take over the market. The goal is to grow so quickly that its rivals like Swiggy's Instamart and Zepto can't compete. This is why the company's total profit goes up and down so much depending on how much they decide to spend on Blinkit's growth each quarter. And there are signs the risk is paying off. While Blinkit is still losing money, it's losing less money than before. The rate at which it's losing money has gotten better, and experts believe it's on track to stop losing money. In fact, many of its older stores are already making money. The overall loss comes from the cost of opening new ones. Zomato is betting that once they stop opening so many new stores, the profits from thousands of Blinkit stores will be released, creating another big source of profit. But this strategy is not guaranteed to work. Building one business on the profits of another is a very careful balancing act, and the whole plan could fail. First, there is a lot of tough competition. Swiggy is spending a lot on Instamart, and well-funded rivals like Zepto are fighting for every customer. This battle could force Zomato to keep spending a lot of money on discounts and new stores for longer than they want to, which would put more pressure on the food delivery business to make even more money. Second, the expansion itself is very expensive. Zomato recently put another 500 crore rupees into Blinkit, bringing its total spending on Blinkit to over 2,800 crore rupees since buying it. If people start spending less money, the food delivery business might not make enough cash to keep funding Blinkit at this speed. Finally, customers in India are known for wanting low prices. A lot of quick commerce's growth has been because of big discounts. The moment Blinkit tries to raise prices to make a profit, it might lose customers to other companies that are still offering discounts. This is a common problem that could force all these companies to keep their profits low for years. So, can Zomato stay profitable? The answer isn't a simple yes or no. Zomato's profit is real, but it's complicated. It's a story of two companies under one roof. A profitable, stable food delivery business that acts as the financial base for a huge, risky and fast-moving project next door called Blinkit. The base is strong, but what they're trying to build is big and costly. Whether Zomato can stay profitable depends almost completely on how fast Blinkit can stop losing money and start making it. The plan is good and they've done a great job so far, but the dangers are real. The real question is, can Blinkit grow faster than it spends money? Or will the tough competition force Zomato to keep spending money for much longer than its food delivery business can afford? What do you think? Is Blinkit a brilliant move or a huge unnecessary risk? Let me know your thoughts in the comments below. And if you enjoyed this analysis, make sure you subscribe for more deep dives into the businesses shaping our world. Thanks for watching.